In this video, we'll share the reasons why we think the US dollar can provide a great trading opportunity with a very important FOMC meeting coming up on Wednesday. Hi guys, it's Arnie here from Forex Source, where we help you to understand and trade the currency markets better. Now, this week ahead video will be covering the trading week from the 17th to the 21st of June 2019. And our main focus point for this week will be a possible trading opportunity on the US dollar. Now, apart from that, I want you guys to be aware of a couple of important other events coming up this week as well. We do have New Zealand quarterly GDP numbers coming up. We have the policy meetings for the Bank of Japan as well as the Bank of England, and some very important Eurozone PMI data coming up on Friday. So make sure to keep track of those ones as well. For now, let's jump to the video and see why we like to look at the US dollar this week and the very important FOMC meeting coming up on Wednesday.
Okay guys, so our main focus point for this week is a possible trading opportunity on the US dollar. Now, we have the FOMC meeting coming up on Wednesday this week, and this event is said to be very market moving. Now, at the moment, the majority of market participants are expecting the Fed to keep interest rates unchanged at this meeting, but the focus will be on what the Fed signals in this meeting in terms of future monetary policy. Now, at the moment, markets are pricing in an 87% probability that the Fed will cut interest rates as early as July. So the expectations for this meeting is for the Fed to possibly downgrade their growth and inflation forecasts, with a lot of focus being placed on what the Fed says about their inflation expectations. So you guys will remember that softer than expected inflation has been one of the key reasons some Fed members has given for their willingness to look for possible rate cuts. So inflation and what they mention about that will be very important in this meeting. Another thing which will be in focus is the Fed's dot plot, which is expected to show that members are expecting policy to remain either unchanged or lower in the short and medium term. So that is definitely something we need to look at for this meeting. So the most important thing for us for this week and for the FOMC meeting, guys, is realizing that at the moment, the market's expectations going into this event is already for the Fed to be dovish and to confirm the possibility of a near-term probably July rate cut. So in terms of trading opportunities, we need to be very careful with this one. As the markets are expecting a dovish Fed already, the Fed will need to be extraordinarily dovish for a sustained sell-off to occur in the dollar following the FOMC. Now, this will probably be the case if the Fed signals that the markets are not pricing in enough rate cuts at the moment and that they see rates moving even lower than current pricing suggests. Now, if this should happen, guys, that would be the ideal scenario to look for a short on the US dollar versus a stronger alternative currency. On the other hand, though, if the Fed comes out less than expected or less dovish than expected, there is a good possibility that the dollar can actually rally following the FOMC meeting. Now, this might happen if the Fed starts talking back the possibility of a expected July rate cut or sticking to their current neutral wait and see mode rather than a cutting one. And giving that forward guidance that rate cuts are on the way. So if this should happen, on the other hand, that would be an ideal scenario to look for a possible long on the US dollar versus a weaker alternative currency. So now that we understand the fundamental reasons for why we are looking for a trade on the US dollar, we can move on to the charts and look in some of the technicals. Now, we'll follow the same technical process for every chart we look at in order to ensure that we stay consistent in our technical methodology. Now, in the case that we get that Fed that comes out more dovish, a lot more dovish than the markets are currently expecting, we could look to short the dollar against something like the Japanese yen, which has been supported recently with the US-China trade war worries as well as the global growth concerns. And in the case, if we have the Fed coming out less dovish than the markets are expecting, I'm currently expecting, we could look to buy the dollar against something like the Australian dollar, which has been pressured by the market's expectations for further RBA rate cuts, as well as the overall risk-adverse tone that we've seen in the markets lately. And so moving on to the charts and looking at the USD yen, we can see that the pair has had over a 400 pip drop from the 112 handle after it peaked close to that 112 handle. And we can also see from the chart, if we just draw in our Fibonacci retracement from the daily swing high to the daily swing low, that we have confluence with the 38.2% Fibonacci as well as the 50% Fibonacci retracement levels, which is both close to that 109 handle. And we also have confluence with the 78.6 Fib which is very close to that 110 handle. Now, in the case of a more dovish than expected Fed, we could look at one of these two levels or areas of confluence as high probability places to look for possible shorting opportunities on the pair. In terms of a stop loss, guys, whether we choose to enter at this first confluence zone or the second confluence zone, we could use this minus swing area, which is just below the 111 handle, as a possible place for a stop loss. In terms of a target, if we use the 100% fib extension, if the pair turns at the first confluence area, we could possibly look to target something which is close to that 106 level. And if the market decides to push the pair higher and it only turns close to the second area of confluence, we could possibly look to target something closer to that 107 area on the chart, which is also very close to this this bounce we had after that massive flash crash we saw in December. So moving on to the Aussie USD, we can see that the pair's made another move down from this very significant confluence area on the chart. We have the 38.2% fib. We also have the 0.70 handle, and we also have this very important previous support area. So the market has moved down, rejected from this level once again. Now, if the pair does move back higher and enters into this zone, guys, and we get that less dovish than expected Fed this week, we can look to this area for a possible short opportunity on the pair. Alternatively, though, if we see a big move in the US dollar, a bullish one, a rally, we could wait for the pair to break either one of these two significant weekly support levels that we have on the chart, which is close to that 0.69 level as well as the 0.68 handle, and then we can wait for a possible pullback back into one of these zones for a possible shorting opportunity on the pair as well. Now, the base case scenario for a stop loss in either one of these two scenarios would be to target the most recent swing high, which is just above this or just below the 70.50 handle. And in terms of a possible target, looking for a target, let's say a move close to the low created here in December would be the best possible case in this scenario, which would be something close to that 0.67 handle, which looks like the best option in case that we do get a technical bounce from this previous swing low that we see on the chart.
Guys, thanks for taking the time to watch this video. We want to remind you that these videos are created to get you thinking and approaching the market like a professional trader. For that reason, we never need to fear the red risk events in the markets like this week's FOMC meeting, as they can be some of the best ways to trade the forex markets. Also take note that these trade ideas are based on the incoming data that we receive on a daily basis, so make sure to keep track of all of that sentiment and fundamental changes as they happen on a daily basis. I wish every one of you a profitable trading week ahead. Until next week, guys. Cheers.